But Indranil, I'm going to bring it to you first to react to the headline number 5.5%.
Obviously, I'm happy because in the sense that we were sort of just about talking about a sub-5 number and the way the RBI would suddenly come and react to these numbers. I think those things will be on the back burner for the next 10-15 days maybe before we get the inflation number and talks about that once again restart. But I would pretty much be more comfortable in sort of talking about no policy change from the Reserve Bank of India on the 17th of September on the basis of this number. And I think if I'm seeing a 5.5 number, the full year number may be closer to a 5.8 to 6%. And given the way the contraction in global demand is happening, the contraction in global GDP is happening, I think the 5.86% number per se is not a very bad number to look at. And thereby what I am implying is that from the RBI's mandate point of view, a containment of inflation risk becomes and continues to be important in the days going ahead.
All right, we also need to look at how the services sector grew. We don't have that number with us as yet, but Gaurav Kapoor, if I could bring it to you to react to that 5.5% headline number.
Well, the number is largely in line with our expectations. And we were looking at 5.2, but our range was between 5 and 5.5. I think the element of surprise or the element of uncertainty to some extent would have come in from the farm sector. And I would think that the farm sector numbers would have been over 2% in this quarter, and services would be somewhere in the vicinity of about 7.5% plus. And with manufacturing sector showing 0.2 compared to a flat growth, I think by and large numbers are slightly higher than our expectations, but no significant change overall in the way one would read the number in terms of the breakup, in terms of what is driving growth and what is not. I think it will be crucial to see the expenditure side breakup of the data as well to get a sense of how consumption is holding up. Because there has been some apprehension even voiced by the RBI that private consumption is slowing down, showing signs of slowdown. We've seen investments being slow or slowing down for the last 2 years, but consumption was holding on. So I would want to see how consumption is holding on and how consumption has held up in this particular quarter, because that would ultimately decide the kind of impact or the demand side pressure on inflation and I think overall growth for the whole year.
All right, Gaurav, and as we speak, we have managed to garner a few more details. Certainly a bolt out of the blue when it comes to the headline inflation number, 5.5%, reiterating that the ET now poll and the general street expectation was close to 5.2 to 5.3%. We also have the industry number, which is higher than 0.7%. It's coming at 3.6. Services sector also, it has grown a bit less than what we were expecting at 6.9%. Remember, the ET now poll was working with a number of 7.5%. Electricity output, we were expecting that to grow over 5%, and it has, 6.3% versus 4.9%. Financial services as well as construction, those certainly merit a mention. Financial services has grown at 10.8% versus 10% on a quarterly basis, and construction has also seen a considerable growth, 10.9% versus 4.8% on a quarterly basis. Mr. Chakra, would like you also to come in on these kind of numbers, and do you think that now as well the main focus and priority of the Reserve Bank of India is going to continue to be to dwell on inflation, or is growth going to take precedence now?
I would think that growth will take precedence, but so contrary to what most economists feel, I feel that there should be a rate cut coming up. Because while construction has grown, I know in the market the real estate sector is really floundering. The prices are holding up and there's no offtake, or the offtake is very slow. With the EMIs coming down, perhaps that will get a fillip and it will go have a back effect on the construction and keep the construction going. So that's it's just hanging in there at the moment. Prices are not coming down and the EMIs remain pretty high. So I would still say from a market perspective that a rate cut, however small it is, a token rate cut, a symbolic rate cut, should be forthcoming.
So Abraham, you'd belong to the camp that believes that the RBI is responsible for the economy's woes.
No. I believe that there is a combined effect of both the RBI and the government. The RBI certainly has its role in monetary policy to keep the inflation under control. And I think they're putting on pressure on the government. And I think with Chidambaram there, he has to do something. He's just taken over. So I think it can't be a status quo. something has to happen, something has to break.
So it is essentially a good set of numbers, and take a look as to how the market is also reacting to that. You saw that immediate knee-jerk reaction for the frontline indices. So the Nifty has managed to see a little bit of a scale up, but nothing great, still off by just about 0.5%, as is the Sensex. But it's the Bank Nifty that certainly saw a good spike up, in fact managed to defend the green line, but now has tempered off marginally, and you've got a lot of banking names which are holding up very smartly as we speak. You've got a Union Bank of India, a Bank of India, SBI, HDFC Bank. All of these counters are doing fairly well. As well as some of the frontliners, you've got the high beta names also seeing a good uptick, as well as your defenses. So Arcom, Arpa, Bharti Airtel, Ranbaxy, those are some of the top gainers as we speak. Coming to you then, Manishi, just wanted your view on the future outlook for the GDP number, because from what we're going by, the FY13 GDP growth estimates is not likely to see a good inch up. What's your view?
See, over the medium term, that is this year and next, our point of view is that it will remain around that 6% number. So somewhere close to about 5.8% this year, possibly increasing slightly to about 6.2 to 6.3%. But I must also mention that I think we're, ascribing just plain undue importance to these aggregate numbers. I mean, honestly, these things don't matter, particularly given the appalling data quality that we have had. It's been repeatedly demonstrated in the IIP numbers in particular. So what matters are actually on the ground variables. How many, how many million tons of cement are being consumed, how many two-wheelers are being sold, how many cars are being sold, what are the, the freight volumes at the ports and airports, both incoming and outgoing. Those are really the, the indicators of real economic action within, and those are the indicators that we actually lay much more weight on.
Sure, but Manishi, the numbers on the ground don't seem too encouraging. Four-wheeler sales were under pressure. Now two-wheeler sales are also coming under pressure. So would you say that the second quarter is going to look far more challenging than we thought the first quarter would?
I think it may, because there are some signs of consumption weakness that are also appearing on the horizon. This economy, as I mentioned earlier, is running on one leg, and that is consumption. Investments have slowed down over the last 1.5 years. And even in the consumption side, if you look at some of the data, like in passenger cars, like in two-wheelers, there has been an accumulation of dealer pipeline inventory. There is an increase in the, in the receivables numbers. And over the last 1 or 2 quarters, there's almost a 10 to 15% decline in the retail sales of the motorcycles manufacturers. So I think there could be, at least 1 or 2 quarters could be really challenging.
Let's also get in Dr. Pranab Sen, Principal Advisor of the Planning Commission, who now joins in on the show. Dr. Sen, thanks very much for taking out the time. We've got a reading of 5.5% for the Q1 GDP numbers, which has surpassed the expectation of 5.2%. What do you make of this number?
Well, it is expected, really. We have been expecting a slight uptick on the services numbers, and I think that's come about. But, mainly the story is not significantly different. We are talking about a relatively weak corporate sector growth story, and as I think Manishi said just now, the investment story simply isn't doing anything. And that message is coming through loud and clear. So now I think there was a question that was raised about, what do we see going forward. Frankly, quarter 2 would be, I would guess, roughly similar, but maybe not as bad as people have made it out to be. Because, what had been happening is that the expectations of a poor monsoon had really led to a cutback in consumption demand, particularly rural demand. I think a lot of that should be coming back, and coming back very strongly. And so I think there are some silver linings to the cloud.
Right, but Dr. Sen, the services sector, which has so far been, contributing to holding up those headline numbers, is also somewhere getting, coming under a fair bit of pressure, because if we had 7.9% in the fourth quarter, it's dropped to 6.9% this quarter, and the expectation is that it could trend lower over the next few quarters.
Well, again, on the services, there's a very strong base effect that's playing out. Last year, if I remember rightly, in this quarter, the services growth was really very high. I think it was near 9%. But by and large, the services have held up, and that's the heartening thing, because there have been doom and gloom stories all over the place.
Dr. Sen, would you believe that one of the main problems also for India would be that over the last many years, the private investment cycle has not kicked in as it did in the mid-2000s, and a big reason for that would also be that the government was competing for the same domestic savings that the private sector was targeting?
Well, that's not strictly true. I mean, if you really look at what happened during 10-11, for instance, there was a massive increase in private investment. The fact is that the government really hasn't eaten into the private savings pool as much as people would like. It is only that the private savings pool has gone down very dramatically. So basically the story that seems to be coming across is not only has the corporate sector lost its will to invest, its savings are down very, very significantly.
All right, hold that thought, Dr. Sen. We'll come back to you in a short while. Gaurav, what's your sense on the inflation reading this time around? Is that going to remain sticky for some time now, and will the priority of the Reserve Bank of India continue to remain inflation, or will it perhaps give more precedence to growth?
I think RBI was made it very clearly at every stage that the slowdown in growth is to a large extent because of non-monetary factors, and recovery to that extent would also depend on improvement of, one, the global economic environment, and two, the improvement in the policy environment. So I don't think the July inflation number will add any sense of comfort, because it was largely on account of fuel. Core inflation actually went up, and given the upside risks to inflation remaining fairly strong, and with inflation expectations actually trending up, I don't think RBI would be in a hurry to change its stance, while it will start to take into cognizance the fact that growth has slowed down. I don't think RBI yet is in a stage where they would look to cut rates, and I think one more critical variable at this point in time is at what stage and to what extent does the Fed come in with another round of quantitative easing, because if there is indeed a fairly large degree of quantitative easing by the Fed, you would see the impact in commodities, particularly oil, which would then have a direct bearing on inflation. And RBI has also at various points pointed out that
Right. All right, Gaurav, thanks very much for joining us on the show with your take on the Q1 GDP numbers. We've also got Dr. C. Rangarajan, Chairman of the Prime Minister's Economic Advisory Council, joining us on the phone line. Dr. Rangarajan, first up, what do you make of the 5.5% number? Do you believe it's come in a lot better than what we were all expecting?
Well, it is consistent with the overall growth rate of 6.7% for the year projected by the Economic Advisory Council. We think that the growth rate will be somewhat subdued in the first 2 quarters of the current fiscal, but the growth will pick up in the last 2 quarters. Therefore, I do not see the current the first quarter growth rate of 5.5% deviating from the path that we have envisaged for the year as a whole.
Sure, but Dr. Rangarajan, there's a lot of concern about the monsoon impact on the second quarter, and already strong signs indicating that consumption is slowing in the second quarter. So would you worry that the second quarter numbers could come in lower than what we've got in the first quarter?
I think the concerns on the monsoon are coming down a bit. I think the August rains have been very good, and according to the latest numbers, the rainfall in August was almost 100% long-term average. Therefore, the prospects of agriculture should in fact be better than what one had envisaged earlier. In fact, when we projected the growth rate of 6.7% for the year as a whole, we had taken the growth rate for agriculture for the year as a whole as only 0.5%. But it may turn out to be better than that. And therefore, I think the monsoon concerns are somewhat subdued now as compared to what we had a month ago.
Right, but Dr. Rangarajan, on the policy front, can we expect that we will see meaningful policy action from the centre to support growth going forward for the remainder of the financial year? Because there have been issues on fuel linkages and land acquisition and a number of such issues.
Well, I think the government is keen on giving a push forward to the economy. A bunch of actions have already been initiated. Some of the concerns which the industry had expressed have been passed on to some to committees to review them. Therefore, I believe that there will be a definite initiative on the part of the government to push the economy forward in the coming months.
Dr. Rangarajan, if we could talk about the road ahead for the Indian economy, because it was once aspiring for double-digit expansion, but it's been hit hard. We've got the declining investor confidence, subdued demand, as well as prolonged political logjam. All of this has stalled key reforms. So how do you see the growth progressing for the Indian economy?
No, I think the medium-term growth prospects remain strong and sound. We are recovering from a slightly lower growth level, but I consider I believe that the current fiscal year would be better than last year, and the following year should see further improvement. Therefore, over in the next 5 years, we should be able to get a growth rate of 8%. Therefore, we may get back to the high growth path in the next 2 years. But for this year, once again, we can expect the growth rate only to be a shade better than last year.
Right, and lastly, Dr. Rangarajan, we've seen private investment virtually grind to a halt. What would you say would be the single biggest factor that will bring investment back?
Well, I think the investment sentiment must improve. But I also believe that the strong growth in some of the key infrastructure sectors like coal, power, steel, and cement could lead the way for improving the investment climate.
Sure, but what do you believe will bring investor sentiment back?
I think there is a very conscious effort that is being made in order to increase the coal production. You see that already. I mean, coal production, steel production, cement production have all increased during the last 3 months.
Dr. Rangarajan, appreciate you taking the time out. Thanks very much for joining in with that perspective.